Welcome to the InterMarket Analysis update. This is a video that I do once a week where we not only look outside of the S&P 500 at other sectors and other indexes within the stock market, we also look at other markets like the bond market, the commodities market, just to kind of get some insight as to what's happening elsewhere to see if it has any impact on the S&P 500 itself. This is being prepared for Monday, January 29th. The first area that we look at is valuation. We look at this looking at past numbers to see on a historical basis, is the market considered to be expensive, fairly priced, or cheap? Then we look at it going forward based on what analysts are projecting and forecasts look like going forward to see what is the market anticipating the valuations will be going forward. That's what the market uses. But we can also look backwards to see what have the valuations already been to get some historical perspective. The first chart that we look at uses a thing called the PE ratio, and these are static numbers from 10, 15, and 20. And anytime we are 20 or above, the market is considered to be expensive. We have the black line on top, which is the S&P 500, and that is well above the red line, which is the PE ratio of 20. To get a little bit closer look, I have the value of the S&P and the PE ratio of 20 down below. When we're above this zero line, that means that we're expensive. So on a historical basis, the S&P continues to be expensive. But as you can see by looking at this chart, that can go on for many, many years. We don't use this as some kind of timing mechanism. This is more to give us an idea of what is the valuation of the market, just to be aware of that. We also can look at this a little bit different way. This is a chart put out recently by Real Investment Advice. The black line is the S&P on top. Then we have the PE ratio of 20, 15, and then 10. This is also confirming what we're seeing in the previous chart. We can also look at this in the context of different events that have happened. We had the 87 crash, the dot-com boom and bust, the housing crisis, of course, the whole COVID plunge, and we can see what were valuations during those times. And most of the time, we tend to be overvalued because when we look back, we tend to see these prices as being overextended. As I said before, the market doesn't always look backwards, it looks forwards. Well, another way that we can look at this is to look at a thing called the Shiller PE ratio. That gives us an average over a period of time to try to smooth things out. The current reading for the Shiller PE ratio is 32.92. To give us some perspective, we have a historical chart of what the market was doing and what the prices were at that time. We can also look at the median and the mean, which is just under 16 for the median and just over 17 for the mean. So when we look at 32.92, we're almost double historically what prices have been. And so this is suggesting that we are overvalued. But as I keep saying, the market looks forward, and we have another thing called the forward PE ratio. And right now we're coming in at 22.44. We're still above that 20 level, but we're a lot lower than we were by looking at the historical numbers. So we take all of this together just to give us some insight as to what is the valuation at right now. Another area that we look at is growth versus value. And I pay a lot of attention to this. When the market's really going up, growth tends to outperform value. When the market is going sideways or even down, value has a tendency to outperform growth. So we want to keep an eye on this and do some different studies to try to get some insight. First, we look at just a pure growth index, and it is in an uptrend. We see the blue line above the red line, and we are going up. Then we look at value, which is also in an uptrend after it had been falling back. It's doing fairly well as we get a little further into 2024. Where this becomes interesting is when we start to look at ratios between the two. The top is growth versus value, showing that growth has been improving here after it had been going down as we finished out 2023. Then on the bottom, we have an inverse of that same chart. This is showing how value is underperforming growth, even though it had been coming back up. The reason why we look at a lot of different charts, which might look like they're the same thing is because all of these different ETFs and indexes and different ways of looking at these are calculated slightly different, and we want to get some confirmation. Just for an example, you can see we saw a moving average crossover with the growth to value ratio on top. It actually was preceded by the value to growth moving average crossing over lower, giving us a death cross, and they didn't occur at exactly the same time. We want to see some confirmations when we're looking at these charts. Another thing that we look at are some ETFs showing how growth is outperforming value, even though it had been showing some weakness. Here's an inverse showing how value is underperforming growth. It bounced back up, and so far in 2024, it is starting to go back down. We look at a longer term version of the pure growth and pure value indexes showing how growth is improving when compared to value. Here's an inverse showing how value is now starting to underperform growth. Then we look at another indexes on a little bit different chart showing how growth has been improving. Then here's another measure using some different ETFs showing how growth has been outperforming and showing some improvement. We're above the rainbow here. And here's an inverse showing how value is underperforming. So we're seeing a lot of confirmation with the different charts that we look at. Then we go in and we break this down a little bit by looking at the small caps. And for most of 2023 and now into 2024, when we look at small cap growth to value, we've been pretty much trading sideways. We've been in a range. Now, as the small caps were showing some improvement, we got up into the higher end of that range, but now we've been falling back. And we are seeing a recent golden cross here with this ratio. We also keep an eye on the mid caps, which have been showing more strength. They seem more of a sustained uptrend, but they've also been fairly range bound as well. And they were actually breaking out, but lately have been coming back down. Then the one that I focus on the most is S&P 500 growth to value, and then taking a ratio of that, where the S&P was going up as we were ending 2023, the growth to value ratio was going down. That's a negative divergence. But lately, we've been seeing this bounce back up. Even over the last few days, it's been coming back down. We keep an eye on inflation. On top, you see a monthly chart of the CRB index. These are commodities, and this is coming right about back up to its moving average and has pretty much been chopping sideways. Then we do a ratio between inflation and deflation on the bottom. And when this is going down, that means inflation is going down. Now, that may seem all wonderful, but if this really keeps going down, that could actually be worse than inflation. So we just want to keep an eye on this. Here's the CRB index by itself. This is a daily chart showing how we did see a recent death cross here, even though the CRB index has been bouncing back up. This is the Baltic Dry Index. Now, a lot of people like to shift forward and place it on top of other indexes. I just look at the regular chart with some moving averages on it here, where we did really spike up. That just means it's costing more to ship products from one place to another, specifically in the Baltics, but it has been coming back down, even though it's still in a longer-term uptrend. Some other markets that we don't trade, not necessarily active in, but we want to keep an eye on them anyway. The first one is aluminum, which continues to be in a downtrend, even though it's been bouncing back up lately. Corn continues to be in a downtrend. Wheat is also in a downtrend. It bounced up, but now is starting to come back down. Fertilizer, it had been coming down, but now it's starting to go back up slightly. Oil, which had been in the mid to low 70s for quite a while, did bounce up this past week, but it's still continuing to be in a longer-term downtrend. This is just a historical chart showing how different things have happened and then what oil did after that. Getting over to the right-hand side, when we really spiked up with oil, that was the beginning of the Russia-Ukraine war. Then we fell back down. This other little spike was when things really erupted in Israel. Lately, it's been coming down. This chart's a little out of date now as we've been going slightly back up with the price of oil. Gas continues to be in a downtrend, even though it has been bouncing up lately. This is diesel, which continues to be in a downtrend as well. Heating oil is also more or less in a downtrend. Natural gas is really kind of jumping around all over, but it's still in a longer-term downtrend. And copper, which is a barometer of the economy, typically when copper's going up, that means that we're looking a little bit better as far as the economy is concerned. When it's going down, that suggests economic weakness. We are in an uptrend here, but copper's been really choppy lately. It fell back down. It looked like we were going to generate a death cross. Now we're starting to come back up as some of the economic reports over the past week were showing that the economy's growing, but inflation isn't necessarily a problem as of right now. We look at a ratio between copper and gold. When the economy's looking better, copper outperforms, and that's really what we've been seeing lately. Gold, which you have a lot of people that are real fans of gold, it's actually been underperforming, and I'll have some more gold charts to show you. Here's a longer term look at the copper to gold ratio. That's the black line, where overall it just shows that copper's been underperforming. We also place the 10-year yield and the 2-year yield here, where we're starting to see interest rates going back up. We're seeing a really wide spread between the green line, the red line, and the black line, where for quite a while they tended to get not all that far apart from each other, even though they're on different scales, and they had a tendency to move in the same general direction. Well, we're seeing a real disconnect over the last few years, and we're wondering, are we seeing a general shift in the economy as this works its way out? Here is gold, which continues to be in an uptrend. It looked like it was starting to break out, but lately has been pulling back. Silver continues to be in a downtrend, but we could be getting ready to see a golden cross here. It was also breaking out as geopolitical events were unfolding, but has been also pulling back. We can look at the closing price of gold on top and then the closing price for silver in the middle, and we look at the correlation between the two. Now, logic would dictate that gold and silver would move in the same direction at the same time, but we're actually seeing this relationship weaken a little bit. When we get a high reading, that means they are going in the same direction. It can be up or down. They just tend to track each other. Well, as this is coming down, that means that relationship isn't as strong as it usually is. Then we can do a gold to silver ratio study on top. That just, when this is going up, that means gold is outperforming. When this is going down, that means silver is outperforming. And then what's interesting about this is we can put the US dollar index down below, and we're seeing that there's a fairly strong relationship between the top chart and the middle chart as they're getting stronger in their relationship with each other. And some general observations that we can make here is when the US dollar index is going up, like it was here, that means the gold is outperforming silver. When this is going down, that means that silver is outperforming gold. Not necessarily anything that we deal with directly. We just use this as some insight. If you are involved in the gold and silver markets, you may find this kind of a study interesting. Here's the dollar index, which continues to be in a downtrend, but it has been bouncing up as we've been coming a little bit further into 2024. Then we look at the euro and compare it with the dollar index, where the euro's been outperforming. I have a standalone chart here in a moment. We also keep an eye on the Japanese yen, which is in a downtrend compared to the dollar. And here is the euro to the dollar, where we're starting to see a golden cross generated right after the beginning of 2024, even though the euro's been falling back and pretty much going sideways. The yen continues to be in a downtrend when compared to the dollar. The British pound continues to be in an uptrend compared to the dollar, but it has been chopping sideways. Some different indexes, and I show this in every daily video. The red line is the equal weight index. That's where all stocks are treated the same. The bar chart on here is the S&P 500 weighted index, and when the big mega caps go up or down, they have more of an influence on the S&P 500. So we try to keep an eye on the relationship between these two. When the red line is underneath the bar chart here, that means that the equal weight index has been underperforming. And that's where we saw a lot of the strength in 2023 is the mega caps were really outperforming. We look at a ratio between the S&P 500, which are stocks, and the CRB index, which are commodities, showing that stocks continue to outperform. Here's an inverse of that same chart showing how commodities are underperforming. We look at the NASDAQ 100, which is recently setting all-time highs, and then we do a ratio with the S&P 500, which is also just coming off of setting all-time highs. And even though they're both doing quite well, the NASDAQ 100 has been doing better, even though it ticked down later in this past week. We look at the S&P 100, which are the biggest stocks in the S&P 500. We were getting a little bit concerned as we were seeing the 100 stocks underperforming, but now they're starting to come back, and we've seen a recent golden cross with this ratio. The NASDAQ, which is still doing okay, but not really back to an all-time high yet, and compare that with the S&P 500, which is setting all-time highs recently, it's showing that the NASDAQ is continuing to outperform the S&P 500. The NASDAQ 100 and the NASDAQ, which both have been doing well, here just shows that the NASDAQ 100, which includes the big mega cap stocks, is performing even better. And we look at mega cap growth, the magnificent 7, which you might be able to drop it down to 6 because Tesla's been under a lot of pressure lately. And we compare that with the equal weight ratio, showing now how the mega caps continue to outperform. And that's where a lot of the strength in the indexes is coming from. We keep an eye on the small caps, and that's the red line here. When this is going up, that means the small caps are outperforming. When this is going down, that means the small caps are underperforming. And it's been pretty frustrating. In December 2023, that's when we saw this ratio really going up. And we thought, okay, here's the January effect. It pretty much has been non-existent in January now, and we're getting close to the end of January as this ratio has been going down. Just for a perspective, we also have the blue line here, which is the S&P 500. In a good, solid environment, we want to see both the red line and the blue line going up. We're not seeing that right now, even though the S&P has been holding up quite well. We look at a ratio between the small caps and the S&P 500. This was when we were going up in December, but lately we've now been falling back. Longer term, we're also in a downtrend with this ratio. The 30 biggest software companies starting to show some improvement and recently seeing a golden cross. The mega caps, this is where the real strength is coming from, setting all-time highs and in a solid uptrend. The robotics and AI ETF is looking better here. It's above the rainbow and starting to show some improvement. But when you compare it on a ratio basis with the tech sector, it is really underperforming. The Dow Jones Composite Average, which takes the Dow, the transports, and the utilities and puts them together, that's just showing that we're pretty strong when we look at specifically the Dow. The transports are okay, but they're negatively diverging from the Dow, and we have been seeing some weakness in utilities. But it's really the Dow that's carrying this composite average. We look at the S&P 500 and compare it with the price of shorter-term bonds, showing how stocks are outperforming. Then we look at a broad market measure of stocks and compare it with further out bonds, showing that stocks are continuing to outperform. Low volatility stocks, which held up better in 2022, they've been going pretty much sideways in 2023. We did see some weakness later in the year, but now they've been coming back, and we're actually in an uptrend with the low volatility ETF. But when you compare it to the S&P 500, it is really underperforming. So it may be in an uptrend, but it is not doing any, in fact, it's doing worse than the S&P 500 itself. Here is the tech sector and comparing it with 3 to 7 year bonds, showing how tech is really outperforming. Then we look at some other stocks, and I show this in every daily video, but I like to include it here since it looks across different parts of the market. This is the advanced decline line studies for the NYSE common stock on top, where we are seeing some improvement. The S&P has been holding up a little better. See, we're closer to this previous high, where the mid caps were showing some weakness, and they're coming back up, but not to that previous high yet. We've seen a little bit more weakness when we look at the small caps. They have a ways to go to come back to this previous high. Then Dow theory, and this is one of the negative divergences that we're seeing, where the Dow is setting new all-time highs. The transports, they're holding up all right, but they haven't even been able to come back to this previous high yet. We want to see these confirming each other. Now, there's some folks that tend to throw this out the window, saying that's not necessarily indicative of what's going to happen. And I'm not saying that this is really leading us to anything either. This is just something that we want to be aware of. If we start to see some real weakness in the market, this may help us as to understand why that's happening. We look at a ratio between the transports and the S&P. When this is going up, that would be more positive for the market. Overall, we've been seeing this ratio going down, and it's kind of been chopping around lately. We look at a ratio between the Dow and the transports. When this is going up, that means the Dow is outperforming. Lately, this has been coming down. That means the transports have been showing a little bit of an improvement, but we're not really seeing any kind of a sustained trend here. Then we look at the correlation between the S&P 500 on top and the transports, and the relationship is getting pretty strong now. So they're having a slight tendency for the S&P and the transports to go in the same direction. It could be up, it could be down, but they're tending to follow each other. Then we take a new approach to Dow theory, where instead of using the Dow on top, we use the S&P, which is breaking out to all-time highs. And instead of using the transports, we look at the NASDAQ, which represents tech. And even though we're not back to an all-time high, we are looking in a pretty solid uptrend right now. So I would suggest that these are confirming each other in the shorter term. Longer term, eventually, we would like to see the NASDAQ come back and set a new all-time high, where the NASDAQ 100 has been setting new all-time highs. There's the FANG index coming off of just setting an all-time high here. These are the bigger stocks, and they tend to be holding up quite well. This is a longer-term chart. I really don't use this unless we start to fall because we're looking for areas of resistance. As long as we keep going up, there's really no need to look for that. Here is ARC, which continues to be in an uptrend, but ever since the beginning of 2024 has been under pressure. Then we look at a monthly chart of the S&P, and we take a ratio of a global index, which covers stocks in Europe, Australia, Asia, and the Far East. When this is going up, that means that the S&P is outperforming. We're also seeing the momentum of this longer-term chart continue to be positive. We keep an eye on bonds, which have been showing an improvement based on price. The total bond ETF is in an uptrend, even though it's been pulling back as interest rates have been inching their way higher. This is a world bond index, which had been bouncing back up. Sorry for having to clear my throat here, but lately has been coming back down, but we're still in an uptrend. We look at a monthly chart of the stock to bond ratio, showing how stocks are outperforming. Here's a shorter term look showing how bonds are underperforming stocks. These are high yield corporate bonds, meaning junk bonds. They continue to do quite well and are getting close to setting all-time highs again. We look at investment grade bonds, which are more conservative. They continue to be in an uptrend, even though they've been pulling back lately. We look at riskier bonds versus conservative bonds, and folks are still tending to prefer to get into the riskier bonds because they have higher yields, even though they have an additional amount of risk. Then we look at a stock to bond correlation, where they're having a slight tendency to go in opposite directions right now. A lot of times we'll see a real strong correlated relationship, meaning that if stocks are going up, bonds are going up. Now they're having a tendency to move in opposite directions. Then we look at the Dow Jones Corporate Bond Index, which continues to be in an uptrend and has been showing some improvement. Here's the 10-year yield where we hit 5%. That's when we hit the low in stocks in October. Interest rates have been coming back down, but now they're starting to go back up. So we're keeping an eye on this. This is a longer-term look at the 10-year Treasury yield. We had come up to 5%, falling back, going back up. We want to keep an eye on this. We're still trying to figure out, are we seeing a longer-term shift in the interest rate environment? For 40 years, we saw lower highs and lower lows. Then we started to go up and set a new range up here, which would be more like normal before we started to see this big decline here. And it looked like, okay, we're coming back down. Maybe that's not happening. But as we watch interest rates go back up, now we're wondering, okay, maybe there is some validity to that scenario. But this is going to take a long time to work out. And this is a chart that I posted a few weeks ago. This is kind of interesting because we don't know if this is telling us something positive or negative. Last October, when we really hit a high rate in the 10-year yield and then immediately shifted and started going down, well, there were two other times when this happened. When we had the Euro crisis back in 2011, and then when we hit the COVID low. Those were negative things. Well, we also hit this low level back in October, and then interest rates started to go down. Okay, but there wasn't necessarily anything negative that happened. And so we're just wondering, did something negative happen that we don't know about right now, or was just market forces taking interest rates from being higher back down to lower? We're just keeping an eye on that. There is some speculation out there. It was almost a year ago when we saw the banking crisis, and then things seemed to be under control. Are we in the eye of the hurricane? Is there going to be more banking problems going ahead into 2024 and beyond? We don't really know that yet. We just know that back in the great financial crisis, things got really bad, then they were good for a while, and then they got bad again. I'm not saying that's what's going to happen, but I'm not saying that's not what's going to happen either. We just want to be aware of these things. And here's the 30-year yield, which had been quite high. It started to come back down. Now it's starting to go back up. Here's the ratio between the S&P 500 and the 10-year yield, showing how we've been going sideways, but longer term stocks have been outperforming the rise in interest rates. The junk bond ETF, which tends to follow what's going on in the stock market, it's been chopping sideways and continues to be in an uptrend. We look at a ratio between junk bonds and government bonds. When interest rates were coming down, we saw junk bonds starting to underperform. Now that interest rates are going back up, we're seeing junk bonds starting to outperform now and are still in a longer term uptrend. This is the price of the 7 to 10-year bond ETF. We're in a longer term uptrend, but momentum, we continue to be in a downtrend, and we're a little bit below 50 with the RSI. So this is more slightly negative. Here's a daily chart of the yields where we had been coming down since October. Now we're chopping sideways and starting to go back up slightly here. This is a weekly chart looking internationally where we're continuing to go up with US and UK rates. German rates are also going up, and we're seeing a bit of an increase in the Japanese rates. We also have another index that we look at to measure the volatility of bonds, and that's the MOVE index. And it hasn't been around all that long, so it's hard to do historical studies on this. And when this is going down, that means the volatility of bonds is going down. Then in the middle area, we have the VIX, which measures the volatility of stocks, and that's been giving us very low readings as well. What I look at the most is on the bottom, and that's the correlation, and they're pretty much neutral right now. So it doesn't mean that bonds and stocks are going in the same direction or opposite directions. They're kind of doing whatever they want right now, day in and day out. Then we look at a monthly chart of the price of the 30-year bond, which continues to be in a downtrend. It was starting to come back up. It got up to this moving average and is now starting to retreat again. And then on the bottom, we have a ratio of bonds to the commodity index, the CRB index, where it's showing that bonds are continuing to outperform. Now, this is a monthly chart, and it takes a long time for these trends to change. Then we look at different sectors. We compare 11 different sectors in the S&P with the S&P itself. And this is showing how materials are underperforming the S&P. Communication has been one of the stronger areas, and that's continuing to outperform. The energy sector has been underperforming, even though it bounced back up as oil bounced this past week. The financials, which took a dump just about a year ago, went sideways, showing some improvement here. That's why we watch this. If there's going to be some kind of problem in the banking sector, we would tend to see some weakness in these charts, and we're just not seeing that, at least yet, but that could change at any time. The industrials continue to underperform the S&P. Tech has been the strongest area, even though it pulled back later in the week. It's still really outperforming the S&P. Staples are underperforming the S&P. Real estate was showing some improvement as interest rates were going down. Now it's starting to decline as interest rates have been going back up. Utilities are also underperforming the S&P, and this is a ratio that I show most every day in the daily video. When this is going up, that means the S&P is outperforming utilities, and typically the S&P is going up. When this ratio is going down, that typically puts pressure on the S&P, and that usually means the S&P is going down. Healthcare continues to be in a downtrend and is underperforming the S&P, also showing here with this other chart how healthcare is underperforming. Discretionary, this has been a real disappointment, and a lot of this can be blamed on Tesla. When this is really going up, that's more the growth outperforming value. And when discretionary outperforms staples, that tends to be more positive for the market. Well, you can see how this is really underperforming the S&P. In a more solid environment, we want to see this ratio going up. And we're just not seeing that right now. The staple sector continues to be in an uptrend, but so far in 2024 has been going sideways. And I take that back. It's actually in a downtrend, but the blue line is starting to come back up to the red line. The tech sector has been the strongest area in the market and is still in a solid uptrend. The semiconductors are also in an uptrend, even though they got hammered in this past week a little bit. The tech sector continues to outperform the S&P. Energy is underperforming the tech sector. That's why this ratio is going down. Growth is continuing to outperform bonds, the more conservative bonds. And the tech sector is continuing to outperform the rise or fall in interest rates. And this is an inverse showing how interest rates are underperforming the tech sector. We look at discretionary versus staples, where this isn't as strong as we would really like it to be. It's still in an uptrend showing discretionary is outperforming, but it has been falling back so far in 2024. Here's an inverse showing how staples are underperforming, but lately have been going sideways to showing some improvement when compared to discretionary. Gold continues to underperform the S&P as gold's been pulling back and the S&P has been going up. We're also seeing gold pulling back compared to the dollar as the dollar's been bouncing and gold is showing some weakness. High leverage loans continue to be very strong and are in a pretty solid uptrend. NYSE composite, which is a broader measure, continues to be in an uptrend. That's positive in the bigger picture. All stocks are getting back and setting new all-time highs. These are stocks in the US as well as international stocks taken together. So that's still looking strong. Emerging markets are chopping more or less sideways, but still continue to be in an uptrend. And here's another look, and this is a little bit outdated now. When we take a ratio of emerging markets and compare it with US stocks, when this is getting down to a really low reading, sometimes that marks a bottom, but we're not really seeing any follow through in the emerging markets, at least yet. They're not falling apart in the emerging markets, but they're not really showing any strength earlier. A year ago, in the month of January, emerging markets became all the craze, and then it just kind of faded out. Then here's some different country indexes to look at in case you want to look internationally at things. We have Mexico, India, Turkey, Indonesia, Brazil, and then the red line is the US. This is a little bit outdated now, but this just gives you an idea how they are performing. This is Bank of America's take. They think that stocks have been holding up fairly well in Japan. They think eventually we're going to go back and surpass this high set back in 1989. We don't know if that's actually what's going to happen, but there's a lot of folks that are anticipating that, seeing that the Japanese market has been one of the stronger markets lately. We look at the micro caps, which are smaller than the mid caps, and they continue to be in an uptrend, even though they've been pulling back. We look at a home builders ETF study. We're not really seeing anything out of the ordinary right now, so I really am not paying attention to this chart. Bitcoin continues to be in an uptrend. They had the news that came out about the spot ETFs being released, and that was pushing the price up. Then it was like, okay, the news came out, so now it's time to sell, and we've been seeing Bitcoin starting to pull back. It actually dropped down below 40,000, but over the weekend, it's been trying to bounce back up into the 40s. And looking internationally, where China's been having some problems, but they are starting to show some improvement here. We're still in a downtrend with emerging markets, showing a little bit of an uptrend in Europe. We're still seeing a downtrend in Japan, even though a lot of folks are really, about the time that these reports came out, that's when we started to see some weakness in Japan. Isn't that interesting? And we are seeing a little bit of an improvement here with the S&P as we look at the US market. This is the InterMarket Analysis chart going back to the beginning of 2024, where we see that oil is doing the best. We have stocks and the dollar just about equal right now. Gold is down slightly, and the price of bonds are also down. Keeping an eye on some correlations where we're seeing kind of a strong relationship between the S&P 500 and the dollar. Sometimes they go in opposite directions. Right now, they're having a tendency to go in the same direction. We also look at the correlation between the S&P 500 and oil, and they're going in the same direction. Oil's been going up. That's the red dashed line, as the S&P has been going up. Now, earlier on, when things started to break out of Israel, that was producing some pressure on the market because that was a geopolitical event that was causing oil to go up. Here, it just seems to be supply and demand is pushing price higher. And so oil can go up and stocks go up at the same time, where a few months ago, they wanted to go in opposite directions. Then we look at the relationship between the S&P 500 and the 10-year yield. And believe it or not, they're having a pretty strong tendency to go in the same direction. The market's kind of figuring out a point of equilibrium right now. And so some relationships that you think would be opposite are actually tending to go in the same direction. We look at the 10-year yield versus tech, and they are also having a pretty strong correlated relationship. The S&P 500 against the 2-year yield, just a little bit outside of the neutral area. They're having a slight tendency to go in the same direction. Then some long-term studies. This is a monthly chart of the NYSE. We're above the red line, so longer term, we're up that way. Also, when we look at the monthly version of the Copic curve, we're also going up there. So longer term, we're in a pretty solid uptrend. This is a daily chart of the NYSE composite, and then we have the NYSE record high percent index. This is continuing to go up, which is also positive. So longer term and shorter term, the NYSE is looking pretty good. Then we look at a monthly chart of the S&P 500. It's above its longer term moving average. That's positive. We're also seeing the percentage price oscillator, or PPO, continue to go up. So longer term, the S&P is still in an uptrend. Then we look at the S&P on top, and then we do a ratio between the S&P and commodities longer term on the bottom. And even though the CRB index did pretty good in 2023, longer term stocks continue to outperform commodities. Then we look at a monthly chart of the S&P and do a ratio with the global index. And when this is going up, that means the S&P is outperforming. This is a monthly chart, so it takes a while for this KST, which is already a long-term oscillator. It's trying to cross over the red line, but hasn't quite done that yet. Then at the end of this video, I make a list of all the positive things and the negative things. My definition of positive as it applies to this video is when the 50-period simple moving average is above the 200-period simple moving average. So the things that are positive, the growth indexes, the value indexes. Copper is still in an uptrend. The British pound and the euro, when compared to the dollar, gold, the big software companies, the mega caps, the FANG index, ARK, the low volatility ETF, the composite average for the Dow and the Dow Jones, all the different bonds that we look at based on price, the total bond ETF, the high yield or junk bonds, investment grade bonds, corporate bonds, junk bonds, and world bonds. All of those are showing positive trends based on price. The tech sector and the semiconductors, the high leverage loans, the Dow, the NYSE composite, the NASDAQ and NASDAQ 100, the mid caps, small caps, and micro caps. Even though they've been very frustrating lately, they're still in longer term uptrends as defined by the 50-period moving average being above the 200-period moving average. All stocks, emerging markets, and then Bitcoin. These are all the uptrends. Then last, I look at the negative trend, and that is when the 50-period moving average is below the 200-period moving average. The dollar is still in a downtrend, even though it's been bouncing back up lately. The CRB index, silver, which could be getting ready to see a golden cross, but not quite yet. The Japanese yen when compared to the US dollar. And staples, which are showing some improvement. They've been bouncing back up, but they're still in a longer-term downtrend. Thank you. I really hope you found this helpful. This is not meant to be necessarily a standalone video. It would help you more if you go in and watch the daily videos that I post, as well as the weekly videos that I post. I hope you have a really good weekend, and I will talk to you in the next video.